Spring of 2002. In a quiet office building in Clinton, Mississippi, Cynthia Cooper is sitting alone at a computer in the middle of the night. She has been running an investigation in secret for weeks. She and two colleagues move their work to the hours after the executives have gone home to ensure their data queries go unnoticed. They fear that if they are discovered, the evidence will be deleted before the audit can be finalized. Tonight, they find it. 28 entries moving massive funds from the income statement to the balance sheet with no legitimate explanation. Without these transfers, WorldCom's reported $130 million profit in the first quarter of 2002 flips to a $395 million loss. She sits with that number for a moment. Then she picks up the phone and calls the board. The investigation is over. The disclosure of the fraud is about to begin. To see how WorldCom reached this point, you have to go back 20 years to a man named Bernie Ebbers. After flunking out of college, he spent almost 2 decades as a basketball coach and a motel owner in rural Mississippi. Ebbers was not a technologist or a financial expert. He was a salesman with an instinct for making deals. He capitalized on the AT&T breakup in the early 80s to start a discount long-distance service called LDDS. That small operation eventually became WorldCom. Ebbers realized his networks had to constantly expand to achieve economies of scale. He would buy a company and use the surging stock price to buy an even larger target. Every new acquisition fueled a higher stock price, which financed the next deal. The pace was blistering. Over 2 decades, Ebbers executed more than 70 separate takeover deals, an average of more than 3 acquisitions every single year. This strategy peaked in 1997, when Ebbers launched a $37 billion all-stock bid to swallow MCI. He outbid British Telecom, a company 3 times WorldCom's size, to pull off the largest corporate merger in history at the time. By 1999, WorldCom stock hit $64 a share, valuing the company at $180 billion. Wall Street analysts were enamored, feeding capital into a machine built on endless momentum. In 2000, that momentum stopped. The Department of Justice blocked WorldCom's proposed merger with Sprint on antitrust grounds. Because WorldCom's model relied on constant acquisitions to mask operating costs, this decision broke the machine. Without a new deal to announce, the stock price began to slide. This decline created a personal crisis for Ebbers. He had borrowed heavily against his own WorldCom shares to finance a private empire of timber and yachts. As the share price fell, banks began issuing margin calls, demanding their money. With personal ruin looming and operations failing, the company's leaders chose to manufacture a profit rather than admit the company was failing. To fix the numbers, Ebbers turned to CFO Scott Sullivan. He was the person Ebbers trusted most with the accounting, and he knew how to make the balance sheet reflect whatever management required. The primary issue lay in line costs, the billions paid every year to lease network infrastructure. As revenues flatlined, these fees generated massive losses. Sullivan changed how these costs were categorized. Instead of reporting operating expenses, his team treated them as capital assets. This allowed billions in immediate losses to be broken into fractions and hidden across years of future depreciation. They hid this manipulation inside the company's own chaos. WorldCom's history of 70 rapid mergers created a labyrinth of competing divisions and redundant billing systems. This environment functioned as a shield, obscuring the lie from external auditors at Arthur Andersen. Quarter after quarter, this mundane spreadsheet manipulation kept the stock afloat, successfully fooling the market for 3 years. By 2002, Cynthia Cooper and her team are tearing through that complexity. Her IT specialist is running brute force data queries that crash the accounting systems. When Sullivan realizes they are closing in, he tells Cooper to delay her audit until the 3rd quarter. She refuses, taking the missing billions straight to the board of directors. The fallout in June 2002 is sudden. WorldCom is forced to publicly admit the fraud. The stock price starts a plummet from $64 down to a single dollar, and 30,000 employees lose their jobs. Within a month, the company files for Chapter 11. It remains the largest bankruptcy in American history. In the aftermath, Bernie Ebbers was sentenced to 25 years in federal prison. Scott Sullivan received 5 years. For her efforts, Cynthia Cooper was named one of Time magazine's Persons of the Year. Coming immediately after the Enron scandal, the scale of the WorldCom collapse broke congressional gridlock. It forced the immediate passage of the Sarbanes-Oxley Act, enacting the most sweeping investor protections since the Great Depression. This $11 billion crime involved no offshore accounts and no complex derivatives. The executives simply shifted a category on a spreadsheet. A broad circle of complicity allowed it to happen. The external auditors wanted to keep the account. Wall Street analysts wanted the stock bumps. The board simply wanted to believe the illusion. Even the mid-level managers who authorized the entries were not inherently malicious. They were cogs in a machine where asking questions was treated as an act of disloyalty. The final lesson of the WorldCom collapse is that the systems and the numbers were not the problem. The culture was.